Hello, everyone, and welcome back to the fourth of four sessions on our human capital due diligence process called Quality of Execution, or QOX. This is, as I said, the fourth session. This will focus on really the culminating outcome of the various models that we've been using for due diligence on a pseudonym company called Biotech Company. And this is the PE Human Capital Valuation Creation Forecaster. This will forecast the value of a lift of human capital management beyond baseline. And so here's really the final output of our diligence on the prospective investment Biotech Company. You'll recall, if you visited the other sessions, this company earned an F grade for human capital management, talent force management. And that asset shown in our three previous human capital diagnostic screens. Now the question is, for the investment committee, is this a good company? We know that already. It's not. The question is, can we fix it? And what's the return on that fix in a quantitative sense? This forecast is the data-driven answer to that question. And what you see on the screen is the bottom line, which is the culmination of those three inputs now forecasted forward. It's our entire turnaround thesis on a single screen, if you will. And so let me just back up a second to reference the three inputs. The diagnostic inputs were the HR risk score, the investor risk model, and the leadership friction model. As you can see, you may recall we started with the middle of those three, the investor risk model, which is really a high-level perspective on human capital management. There were some red flags coming out of that diagnostic, pretty bright red flags, honestly. And so that invited us further in to look through the same company's human capital management systems and platforms and people in what we call the human risk HR risk score. So we did that as well. It kind of corroborated what we saw in the initial diagnostic. And then lastly, we went further into more of the behavioral dynamics among the senior executive team, which was also pointed to as a potential risk in each of the previous models, and got deeper into that via the leadership friction model. So again, welcome to this video on the QOX Suite series. I'm, as you may know, Jerry McDonough, and I'm the founder and managing director of NextArc Leadership Solutions. And for 30 years now, I've worked with leading PE firms like TH Lee and Ridgemont Equity Partners, FTV Capital, and others to quantify human capital risk in due diligence and build day one human capital acceleration plans. And so, as we've detailed in the first three parts of our diligence story, the forecaster isn't a standalone calculator. It's again, the culmination of our diagnostic process in its entirety. It's a strategic forecasting tool for PE operating partners and portfolio company leadership teams to model the financial upside of investing in human capital. And it works by using the outputs from our diagnostics as validated defensible inputs to project the financial return. So those are the three inputs, and now the forecaster. And let me go back to the results for this pseudonym company, Biotech Corporation. And so how do we build the financial case for this turnaround with confidence is really the key question. We can't just guess, right? So we use the specific data points from our three-part diagnostic. First, the leadership and execution alpha slider, which you'll see here, is influenced by that, and you'll see currently at 2.25%. So this adds a percentage directly to the baseline EBITDA growth. Our justification for this alpha comes directly from the leadership friction profile. We diagnosed, as you may recall, a hub and spoke culture where the CEO was a bottleneck in decision-making, creating kind of a low ceiling on our growth plan. We knew it was going to be an impediment, and there wasn't a strong number two internal candidate for the succession. And our value creation plan to distribute decision rights among three other very capable leaders while we install a new CEO in year one, establish shared company-wide goals, and align incentive plans provides the clear rationale for a significant growth uplift as the company finally starts executing as a single unified team, which wasn't the case, right? So that's the rationale for quite conservative 0.25 lift on the leadership and execution alpha. The talent and culture premium slider. Right now, this F grade asset deserves a discount, not a premium, right? So this premium is what our value creation plan will create. It's justified by the plan to address the systemic failures we found in the HR risk score, and the plan to move this company from an F grade to a solid B by exit provides the case for a 0.2x, again, a very conservative multiple lift for that expansion, as we fundamentally de-risk the asset and make it a higher quality, more valuable company for the next buyer. So that was at 0.5. It's gotten a lift of 0.2 to 0.7x, right? So that's the talent and culture premium that we can expect from the investments being made. Finally, the total human capital investment. This is directly anchored by the human capital debt we quantified in our initial investor risk model, which was around $730,000, give or take. It's the real upfront budget required to begin fixing this F-grade asset. For the purposes of the forecast, we've distributed this across 205 FTEs, roughly $3,500 per FTE. Though in reality, these investments, I think pretty obvious, won't be amortized across all 205 employees equally. They'll be much more targeted. And so by connecting the diagnostic to the forecast, we calculate the human capital ROI, which is the incremental value created divided by the total human capital investment. And in a turnaround scenario, I'm sure preaching to the choir, this number is everything, right? In the context of private equity, an ROI of really 5 to 10x is considered very strong. A return of 18x or higher, as we see here, demonstrates a highly compelling case for taking on the risks of the turnaround. So that's how we explain the rationale behind the lifts here, and the bottom line baseline exit scenario versus the NextArc accelerated exit using the 𝗘𝗂X diagnostics and acting on those. So this is how we stop flying blind in the process. We diagnose specific issues, calculate the cost to fix them, and forecast the financial return. In this case, total human capital investment was around $17,500. The human capital ROI was 18.1, and the incremental value created by human capital was in excess of $13 million. So I invite you again to access all 4 of the 𝗘𝗂X models free of charge by visiting our website. It's nextarcleadership.com and clicking on the Unlock 𝗘𝗂X Suite button. You can use that to do retrospectives on recent deals or contemplate future deals and really just explore how the models work and how they interact and interrelate. And stay tuned for the next installment of our human capital due diligence and day 1 acceleration process, where I'll describe the results of, and we're really excited about this, a 6-year primary research study that we conducted on the 𝗘𝗂X process and the real results it turns in for portfolio company management. So thank you.